In this video, I'm going over my top 3 recovery stocks to buy right now. I'll show you some of the key reasons why I'm choosing to invest in these stocks, as well as where these stocks could be priced at in the near future. And stick around to the end of the video for a bonus stock. Hi, my name is Jeremy Zargami, and welcome to my channel. Today, I'm going to show you my favorite recovery stocks that I'm investing in right now. If you haven't already, click that like button, because the way the YouTube algorithm works, if you don't hit that like button, YouTube will show this video to less people. So to help more people see this great content, hit that like button down below. And please consider subscribing if you're committed to learning and growing to ensure that you have the best financial future possible. And don't forget your 4 free stocks. 3 free stocks when you sign up with Webull and deposit $100 onto the platform, with 2 of those stocks potentially valued up to $1,600 each. And get 1 free stock when you sign up with Robinhood. Use the links below in the description. Let's get into it. The pandemic hit the market really hard in March of this year, dropping 12.93% in one day. In a 1-month span, from February to March, the S&P 500 dropped 33%, and it hit its bottom on March 23rd. Since then, we've seen the market skyrocket back up, forming a V-shaped recovery in a very short period of time, in large part due to the big tech companies like Facebook, Apple, Amazon, Netflix, Microsoft, and Google. These 6 tech companies make up roughly 21% of the S&P 500. And since these companies have been benefiting greatly from the pandemic forcing us into an even more digital world, their stocks have been on a tear since March. While it seems like the market has made a full recovery, there are still a lot of sectors that have been slower to make a comeback. These sectors are considered recovery sectors. Because the virus is still spreading through our country, and for most of the US, things are still shut down, this is affecting the way that people are spending their time and money, which has a direct impact on businesses, and in turn affects the stock market. Some of the recovery sectors include energy, financials, consumer discretionary, and healthcare. While the tech stocks have been the pretty girl at the party this year, the recovery stocks have been the wallflowers that people tend to forget about. This is our chance to swoop in and talk to these wallflowers and get to know about them before they get hot. What I'm trying to say is that these recovery stocks are some of the only stocks that are still on sale in this new bull market. So now is the time to buy these stocks. But before you do, be prepared to hold on to these stocks for at least the next 5+ years, because no one knows exactly when these stocks will recover. But when they do, you'll be glad you invested in them at such a discounted price. Before I get into my first stock, I want to give a shout out to my boy Nate Hughes for hooking me up with this awesome shirt. It's part of the human campaign that he's running through his ministry and through his church, The Grove in Arizona. These awesome shirts, if you're wondering why the human is upside down, it's because if you're having a tough day, if you're having a tough year, and you're hanging your head is hanging down, it's a great reminder that we are all human. Okay, it's something that unites us, our humanity. I think it's an awesome concept. The shirts fit great. I'll show you the back real quick. Here's the back. It says human. Okay, so I'll put his Instagram below, and I'll put his ministry below as well, Reconcile the World, and you can follow him there. You can go to Reconcile the World, click the link in the bio, and you can buy one of these shirts. And there's black and white, and you can get them as Christmas gifts. You can get them for yourself. It's a great ministry. Please go support them, and it would mean a lot to me. So thank you guys. Let's keep going. The first stock on my list is JPMorgan Chase, ticker symbol JPM. JPMorgan has become the largest bank in the US, with its total assets at $2.82 trillion. Yes, trillion with a T. That's a lot of assets. At the time of recording this video, JPMorgan Chase's stock is valued at $100 per share. They have a price to earnings ratio of 13, which is really good. That shows that this stock could be undervalued, which is the whole point of investing in these stocks. This follows the buy low, sell high motto that a lot of investors like to follow. My motto is more like buy low and hold forever. There are some cases that I would sell, but it would be more to transfer over assets into something like an investment property. Going back to the stock has a dividend yield of 3.59%, which is a solid dividend yield. This helps motivate investors to keep holding on to these slower moving stocks, because when you see a little bit of passive income coming in every month or every quarter, you won't feel like your money is just stagnant in these investments. Morningstar has JPMorgan's fair value price at $112 per share, which shows that they believe this stock is slightly undervalued. They say their economic moat is wide, their uncertainty is high, and their stewardship is exemplary. Everything looks good here. The uncertainty being high makes sense because these are recovery stocks. So it's hard to say what these companies will do in the near future, but long term, this company isn't going anywhere. The second stock on my list is CVS, ticker CVS. I talked about CVS in one of my other videos, which I'll link above and below in the description. But CVS is poised to benefit big time from all the vaccines it'll be distributing once we have a safe and effective vaccine. CVS recently hired 15,000 pharmacy workers to help with the demand that they're expecting in the near future. CVS does a great job of getting customers into their ecosystem and keeping them there with multiple aspects of service. At the time of recording this video, CVS is trading at $60 per share. With a price to earnings ratio of 9, the stock is very undervalued. It has a dividend yield of 3.44%, which is a solid dividend yield for long-term investments. Morningstar has a fair value rating of CVS at $92 per share, which shows how undervalued they think CVS is right now. Morningstar says their economic moat is narrow, their uncertainty is medium, and their stewardship is standard. So pretty solid across the board for CVS. I recently doubled my position of CVS because I feel like they're going to be very involved in the actual recovery of our country from this virus, and I think they stand to benefit greatly from that. The third stock on my list is Chevron, ticker CVX. Chevron is one of the most recognized and respected companies in the energy sector, but because of the virus, everything was shut down, which meant hardly anyone was driving or flying. This took a huge toll on oil companies like Chevron. Their stock dropped 55% from January to March, and since then has been on a slow road to recovery. While the world is moving more towards sustainable energy, I still feel like the oil companies have time to recover and thrive before they truly feel the effects of the world going green. This gives us time to make some money off of heavily discounted stocks like this one. At the time of recording this video, Chevron is trading at $71 per share. They currently have a negative PE ratio because they lost money last quarter, but they are boasting an extremely high dividend yield of 7%. But you have to be cautious when companies' dividends get too high because they can always cut them or reduce them if they need cash. But if they don't, and you see this company recovering in the next few years, then enjoy the passive income as this company works its way back up. Morningstar has Chevron's fair value price at $111 per share, which means that it could be a great time to buy. Their economic moat is narrow, their uncertainty is high, and their stewardship is exemplary. People are starting to get back out on the road and travel a little bit as well, which I think will help boost up Chevron's stock in the short term. But once things go back to normal, that's when the stock will really shoot up. Since you stuck around this long, here's your bonus stock. The bonus stock is Citigroup, ticker C. Citigroup is the fourth largest bank in the US, holding assets totaling $1.63 trillion. The pandemic hit them hard as well, dropping their stock nearly 60% from January to March. At the time of recording this video, Citi is trading for $42 per share, with a PE ratio of 8, which is really good, and a dividend yield of 4.83%, which is a really high dividend yield without it being too high. 4 to 6% is right around that perfect dividend yield zone. You'll get a great passive income source, and it's less likely that that company will cut its dividends when it's around that percentage. So it's a safer bet if you're looking for that dividend income. Morningstar has Citi at a fair value price of $68 per share. Their economic moat is narrow, their uncertainty is very high, and their stewardship is standard. Citigroup has done a great job of cutting costs, and now they're at the point where they can go back on offense and start making some moves to grow again. This is a great time to get ahead of the wave. That's how I feel about all 4 stocks that I've talked about today. These stocks have been flat for the last few months, but the waves are starting to roll in, and it's up to us to find good companies that's waves are coming back. We need to get our position in these companies now so that when the big wave comes, we can catch it and ride the gains all the way to shore. I hope you got value from this video. Don't forget to hit that like and subscribe button. It greatly helps out this channel. Comment down below with any questions or feedback. I would love to hear from you all. And be sure to follow me on Instagram. I post there pretty much daily. And don't forget to get your 4 free stocks using the links down below. Thank you so much for watching, and God bless.